Hi everyone. Today we are going to be looking at accounting principles, specifically the revenue recognition principle. In order to understand what the revenue recognition principle is, we need to first understand what revenue is. Revenue is the income that is earned by a business by the provision of services or sale of goods. Now that we know what revenue is, we can define the revenue recognition principle. The revenue recognition principle is a principle that states that revenue should only be recorded once it is earned, not when the associated cash is received. There are two bases for recording revenue, a cash basis and an accrual basis. The main difference between these two bases is when revenue is recorded. The cash basis records revenue when cash is received, that is, when cash changes hand from one party to another in a transaction. The accrual basis records revenue when it is earned, regardless of when payment is made. The revenue recognition principle is only applicable under the accrual basis of accounting, as we are recognizing when the revenue is earned. Hence, it abides by the matching principle and accepts the preferred method of accrual accounting under the generally accepted accounting principles of recording revenue when it is earned, which enables the financial statements of a business to be truthful and gives a clearer picture of a business's success. There are two types of revenue that we can record, deferred revenue and accrued revenue. Let's take a look at an example to help us understand the two. Meet Kate. Kate is a secretary who is bored of her plain office and wants to redecorate. On October 12, she visits Priority Designs and pays them $500 cash to make over her office during November. On November 16, the members of Priority Design go to Kate's office and redecorate to make it more modern. So cash was received in October and the service was performed in November. When is the revenue recorded? The revenue is recorded in November because that is when the revenue was earned. This is known as deferred revenue because cash is received before the revenue is earned. 2 years later, Kate decides she wants to redecorate her office again. She was so impressed with Priority Designs 2 years earlier, so she called them back again. They were available on the 17th of April and went to her office and redecorated it. Kate was not getting paid until the 30th of April. Therefore, she didn't pay for the service until the 2nd of May. So the service was performed in April and the cash was received in May. When is the revenue recorded? The revenue is recorded in April because that is when the revenue was earned. This is known as accrued revenue because cash is received after the revenue is earned. Now a summary of what we have learned about the revenue recognition principle. Revenue should only be recorded once it is earned, not when the associated cash is received. Deferred revenue is when cash is received before the revenue is earned. Accrued revenue is when cash is received after the revenue is earned. And the revenue recognition principle is only applicable under the accrual basis of accounting.